The sad truth about bookkeeping. The time spent thinking about or complaining about bookkeeping is much bigger than the time spent actually doing the bookkeeping. Very similar to what you did as a teenager. The time spent thinking about or complaining about homework was much bigger than the time spent actually doing the homework. It's time to start making the right choice. If you own a business, you must own the bookkeeping and simply get it done. Here's a definition of bookkeeping. The process of recording, organizing and tracking financial transactions and information for a business or organization. Owning it doesn't always mean you have to do all of it yourself, but you have to own the process, even though others might actually be doing part or all of the work for you. Set yourself high standards for the bookkeeping of your business. It needs to be structured, repeatable, robust, up-to-date, simple, complete, and accurate. If that sounds a little boring, then think about what happens if you don't make the right choice. The bigger the bookkeeping mess, the more rework, the higher the number of questions, the more time you spend, the higher the bill, the longer it takes to know where you stand. Own it and get it done. You need to set yourself up for success from the very start. Structure creates calm. First, register your business before you start charging customers, hiring employees, or raising outside funding. Second, open a business bank account to separate business and personal funds. Your business bank account transactions are going to be one of the key data feeds into an accounting system. Use clear description lines for any bank transaction you make, which will make the downstream work a lot easier. Side note number 1. Money transferred from your personal bank account to your business bank account to fund the business is called equity. Side note number 2. No BS. Keep it very, very simple. No pockets in the business bank account. No rounding up of spare change from transactions to build your savings. These create way too many transaction lines that have no value whatsoever and only complicate things when you are reviewing what came in and what went out. Third, keep track of transactions. Categorize your business transactions. For example, labeling expenses you incurred as rent, insurance, software, or travel spending. Review your business transactions. For example, were all the charges legitimate? Or are there double payments or mystery charges? Reconcile your business transactions. For example, does the total of what we logged as sales transactions match the income and payments from customers? Close the books on a monthly basis. That way it's much easier to trace back what happened in case things don't tie out. And you have the benefit of knowing exactly where you stand with your business based on the latest information. Depending on the type of business you run, you will need to make good choices about the operational systems you are going to use. For example, which robust systems do I need when I run a web shop? At the core will be the inventory management system. Next to it will be an invoicing system and the purchasing system. Or possibly all three of these are interrelated as modules of one ERP system. Each of the systems needs to export transactions to the accounting system that sits at the back end. What if you run a small consultancy company? At the core, the time registration system. How many hours did we work for which customer? Next to it, the expense claim system for the consultants. Planes, trains, hotels. These two systems are instrumental in running the invoicing system. And all three of those need to feed the accounting system. What's the reward for your big bookkeeping efforts? Accurate and timely information on how your business is doing, which allow you to make decisions based on data. Once you finish closing the books, you can prepare financial statements that tell you a story. The income statement tells you about the profitability of your company. Revenue minus expenses equals profit. Or sales minus costs equals income. The income statement covers a specific period, a month, a quarter, or a year. It's like a movie about profitability. The balance sheet tells you what your company owns, OWN, and what it owes, OWE. The balance sheet covers a specific date, month end, quarter end, or year end. It's like a picture at a point in time of your company's financial position. The cash flow statement tells you about the inflows and outflows of cash during a period. The cash flow statement is also like a movie, covering a specific period, but this time the topic is cash rather than income.